Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. We begin with our top story. Stocks rebounding from a three-day global slump. Caron of Morgan Stanley saying the sell-off is a correction rather than the start of a bear market, writing the magnitude is not unusual, but the speed at which it's happening is. As long as we have a soft landing, then we think the sell-off represents a reset of prices, a buying opportunity, but cautiously, patiently. Jim joins us now. Cautiously, patiently. Jim, let's get into this. Did we learn more about positioning than we did about fundamentals in the last couple of days?
Absolutely. I think that this move in the market has a lot more to do with positioning, over leverage in some cases, volatility, than it does the economic fundamentals. And look, you were just talking about it on the show. I mean, we have a yen carry trade that's going through. We have, other crowded positions. Now, we have to recognize that the markets were in a period of very low volatility. I mean, the VIX, just a month ago was somewhere around, 11 or 12. 24 hours ago, it went to 65. And effectively, that is a significant move which causes people to de-risk very quickly. So the low volatility period allowed people to build very crowded positions and actually get rewarded for them. So I think what stops this, and this is always the question mark, is when an asymmetry starts to appear, meaning that there's more upside risk than downside risk, or the upside and downside risk components balance. Where is that level in the market? It's hard to say, because like you were saying, that there are many of these positions still probably need to get unwound. So yes, we may have a reprieve today. Yes, we may bounce back today, but that only may give people the opportunity to sell again in order to get their positions and their volatility more squared. Even if you look at the put-call ratios in the equity markets and everything, I mean, we're talking about moves. I mean, you said it earlier. I mean, we had 1987, for the Nikkei, type of a move, and then 2008. This is like the stock market crash of 87. This is a financial crisis in 2008. These are the types of moves we're having today. I don't think the economic fundamentals justify 1987 or 2008 to justify these moves. And I think what people are looking at is they're looking at these moves and they're extrapolating from these moves a fundamental economic story. I think the fundamental component of this is very slow moving. Yes, things are slowing down. Yes, policy rates are high. Yes, the Fed's likely to cut rates this year, but I don't think it necessarily derails, where we were before. So I think that this is somewhat overdone. Doesn't mean that we can't go down, but if it does, I still think that we are in more of a secular bull market. This is not the start of a bear market. And we are going to be looking at opportunities to add to risk. In fact, what we're doing on our team at Morgan Stanley Investment Management is we are going on we're creating our list, right? We want to shop on sale. We want to find many of the positions that we weren't able to get into that have run away from us to high prices that might be on sale and might be looking interesting. So there are opportunities out there, but you've got to be cautious, patient, don't do it all at once.
Let's unpack some of that then. What's on sale right now, has been on sale over the last few days, that you've dipped your toe into, that you like and have started to buy?
Yeah, well, I mean, one of them has just been broadly the Nikkei Japanese equities. I mean, that's one. Now, we were long that. Now, don't get me wrong. I mean, we got long that in March of 2023, so we've been riding that up quite a bit. But, like anything else that goes up, we weren't long enough. So, with some of the setback, these are things that we started to take a look at. Other things like some of the semiconductor stocks in those sectors start to look relatively interesting to us. Looking at factors. So thinking about quality. So we like to think about buying quality, but at a reasonable price. So this is, these are balance sheet factors, strong balance sheet companies, and high quality factors, interest coverage, things like that, are just looking more attractive today, where even if we want to broaden out our portfolio, diversify it more away from large cap and big tech, I think that there are some good segments of the market and some good quality factors that are out there that actually represent that can actually represent an opportunity. Now, what I do think is a little bit overdone, though, to fund some of this is a bit of the move in the interest rate markets. I think the bond yields have priced in, Fed cuts going down to 4%, maybe even 3.5%, depending on how you want to look at it. I think the bond market has moved quite aggressively. And, even if you look at the bond market from point to point, if we look at the start of the year this year, 10-year Treasury yields were about 4% on January 1st. Today, they're at 3.85. Okay, so clearly there's been move up in yield in between then, and now it's come back down, and the speed of the move. But point to point, the bond market is actually relatively steady. It's giving you a nice little coupon, and returns are up around 3% in fixed income, which is okay, right? And this is kind of what you want. But the point, though, there is that most of this right now, most of the return is now coming from the yield move lower, and I think that might be a little bit on the overdone side. So we may fund some of our equity positions by selling some of our bond positions because interest rates went down so much and the prices appreciated quite rapidly.
So if we're in the secular bull market for equities, bonds have moved too far to 3.85. What is more reasonable, Jim? What's sort of an analogous trade to what you see on equities?
So, I mean, the way that I kind of think of it is as a range type of a trade. So for me, the level 5,200 in the S&P 500, represents the beginning levels that you would want to start to think about buying. And the reason I say that is I key everything off of what I believe is a level that's more fair for equities today. If I look at the S&P of around 5,350, and that's roughly 19.5, PE. That's a 19.5 multiple on 275 earnings pulling forward from 2025. So if I think about the overshoot that we've recently had, that went up to 5,500, 5,600, and I think about that more symmetrically, it tells me that 5,150 to 5,200 on the downside from that 5,350 center actually starts to look relatively attractive. So today it would look like we're a little above that. But like I was saying earlier, with this rally in the market, what this may do is it may give some of those positions that still needs to be unwound the opportunity to sell into some of the strength, and they could push prices back down. But that's where the asymmetry begins. Around 5,200, around 5,150 in the S&P 500, I believe the upside potential for markets relative to the downside, even if you have a deeper correction in equities, becomes more symmetrical. So that's where I start to pull out the buy tickets. And that's what we're looking to do at this point. Now, if I thought we were in a secular bear market, and if I thought this was going to be the start of something really big, no, then I wouldn't do it. I mean, I would think that, the downside has a lot more room to go. But that's not where we are. In my view, I think the economy is cooling. It's not collapsing. Yes, earnings may start to slow as forecasts come out. Unemployment rate rises. There's less strength from the consumer. Certainly, that's going to be a little bit of a drag. But, in many cases, I still think that the jobs market is going to maintain, relative strength. The people who are very bearish on the bond market, or I should say on the equity markets, are people who believe that the unemployment rate is going to 5-6%, right? That we're going to have this major adjustment higher. There's going to be this big layoff spree that's going to come through. Right now, layoffs aren't actually showing any real meaningful acceleration. Yes, temporary workers aren't being hired rehired as quickly, and there is some softening in the labor market. That's good for the Fed because it lowers wages, and lowering wage inflation keeps inflation down. But I don't think necessarily it's an overall collapse in the market. I view it more as a normalization, and we have to draw that distinction. Is this a significant negative change, or are we just normalizing? And I think we're more or less normalizing at this point, but there's going to be overshoots to the downside, and I think those overshoots can represent buying opportunities.
And yet, Jim, here we are. I want to squeeze this in because I think this is so important. you say that what we've learned in the last few days is we've learned more about positioning than we have about fundamentals. And I think a lot of people might agree with you. I just want to reflect on what another Jim said earlier this morning over at Deutsche Bank, Jim Reed. What a once-in-a-lifetime GFC period could not do, and a liquid August day in 2024 with one bad weather-related payrolls print for fuel did, with some ease, for a period of time yesterday. What would have happened if we'd seen a negative payroll print? Jim, I've got to ask this because I just wonder how fragile this market actually is. So if you're saying this is just normalization and nothing nefarious, I wonder what happens to this market when we do have to confront something more nefarious. Just how unstable are things, Jim?
Yeah, listen, I think it's a good point. I mean, if we have a material deterioration in the data, then I would argue that, yes, I mean, maybe there is something bigger that's going on. So if I compare that to many of the crowded positions that are likely still out there, look, we could have another 5 to 7% downside correction. It's not uncommon to have about a 10% correction in the equity markets. I mean, this is kind of a normal thing that, that happens on a regular basis. But that, I think that kind of misses the point. I mean, if we start to get something in excess of a 20% correction, that's typically the signal where a bear market might be starting, or there might be something bigger that's actually taking place. But right now, when you look at corrections, 8, 10%, 11%, which is what we've roughly had over the past 48 hours, let's say, Monday and Friday. This isn't something that is overly unusual. And I think that we as investors need to be patient, and we need to take this in stride a little bit. And that's why I keep going back to this, right? We have to ask ourselves the fundamental question. Is this the start of something bigger, and is this a bear market? Or is that what's happening right now? Are we going to see an absolute collapse at this point, and sudden stop in economic activity?
Yeah.
Is that what's happening right now? If it's not, then I still think that the bull trend is intact, and we want to be able to find places to buy.
Got it. Jim, enjoyed this. Thank you, sir. Dutta of Renaissance Macro writing the following. The time for debate is over. The Fed needs to recalibrate policy now. Our call is that the Fed delivers a 50 basis point cut in September, with at least another 50 basis points of cuts spread across the next 2 meetings. Going more in September makes up for not going in July. Neil joins us now for more. Neil, I said the Fed's being cool, calm and collected. Some people watching might say cool, calm and complacent. But you say the following, and I think your note in the last week following payrolls on Friday is an important one. You said they've stepped on a nail, not a bed of nails, and you went on to say this is easy to fix. Neil, why is this so easy to fix?
Well, thanks for having me on, John. I think it's easy to fix because there's nothing structurally wrong with the U.S. economy. Everything that ails the economy is a function of tight monetary policy. I mean, nobody's talking about a troubled asset relief program. No one's talking about a resolution trust corporation. So, I think that that's important to keep in mind. What we're dealing with is simply a function of the Fed keeping rates too high. And that means that lower rates can be the solution to what ails the economy. I think for the Fed, it's important. They talk about not wanting to make one data point too important, but it feels like that's what they're doing. I mean, you already see this with the debate between 50 or 25 in September. Well, if the jobs number comes in strong for the August reading, we'll go 25. But if it does what it did last month, we'll go 50. I mean, that's ridiculous. We already know the revisions to these numbers are negative, right? So whatever the number is, it's gonna be weaker, in hindsight. And the unemployment rate continues to march higher. And we know that the momentum under the economy is weak, and we know that there's an asymmetry with respect to how firms deal with bouts of market volatility. Higher market volatility spooks them a lot more than lower volatility makes them feel good, typically. So, I just think I've been saying it, they need to get on with it. But I think the longer they wait, the more they'll end up having to do, which is why I say that not only will they go 50, but I do think they'll go at least 50 more in the final 2 meetings of the year. So that's sort of how I'm thinking about it. But as I say, I mean, I do think the markets will respond reasonably well to to lower interest rates, and I think that will help stabilize the economy.
Credit to you, Neil. You've been calling for this for a while. I just want to pick up on an important distinction. I hear from you loud and clear what you think they should do. Do you think they are dependent on that jobs report in August on going 25 versus 50? Do you think it comes down to that?
I mean, it seems that way. Look at the Wall Street Journal this morning. They had an article talking about how the next employment report is going to basically determine whether or not they go 50 or 25. But Powell has also talked about how it's the totality of the data. What if core inflation comes out very soft in the next report for July? I think that there's a reasonably good chance of that happening, given what we know about the deflation in cars, the cracking in housing rental inflation, and the ongoing weakness in non-housing services. There's good reason to think that we'll get another dud on core inflation. So now not only is the employment figures weakening, but core inflation is converging onto 2% more rapidly than they thought after the first quarter. So it's also about the outlook, right, John? I mean, what's the upside case for why employment will pick up? We get a weather bounce back? I mean, it's crazy. Housing is slowing. If you look at the number of new homes that have been sold that haven't been started, that's down over 30% against last year. That's going to bleed into single-family residential construction. It's unlikely that we get the kind of inventory investment rebound that we got in Q2 in the back half of the year. That's going to weigh on manufacturing, and total hours worked in manufacturing already slowing over the last 3 months. And the fact that the labor markets have slowed means what? Incomes are slowing, which will take some of the upward momentum out of consumer spending, which the Fed has been optimistic about. So it's not about just waiting for this data to come out. It's also about thinking about what the outlook might be. In my mind, the data already justify a 50 basis point move. I mean, the fact that the unemployment rate is up to 4.3%, that's 30 basis points higher than where they think it's going to be by year end. You put that into a standard kind of Taylor rule model, you get at least an additional 60 basis points worth of rate cuts. So it's not about just the data as it's come in, though they keep wanting to make it about that. It's also about the economic outlook. And, I don't think there's really a right tail for growth. I think the distribution of risks is skewed to the downside, and it's important for the Fed to neutralize those downside risks by easing monetary policy.
Yet, Neil, Mary Daly yesterday saying that risks are equal between employment and inflation. That does not sound like a woman who's ready to cut 50 basis points in September.
Well, that's what I said, and I mean, you're right, and I do think the Fed has a role to play here in trying to get on the right side of the 8 ball. But what's happening in the markets, I mean, leaving aside the sort of unwind of positionings and things, I mean, the big move in yields happened in the 2 days following the meeting. Why? Because the data was weak. The risks aren't balanced as much as they want to. This is really about them. It's not about them knowing something the market doesn't know. This is about them realizing something the market and most investors already do know. And that's why I think, you're in this point now where if you get bad data, it's going to lead to bad market outcomes, because anything at this point that looks weak in terms of the economy will kind of fuel these bets that the Fed's behind the curve.
Bad news has been treated.
The markets already know, guys. The markets already know that the risks aren't balanced. Whether they say it or not is another matter.
Just waiting for the Fed to catch up, Neil. It's good to hear from you, Neil. Dutta there. TD Cowen raising its price target on shares of Walmart to 80 from 75. Analyst Oliver Chen saying the company is well positioned to continue momentum across a leading retail tech ecosystem. That stock is up by 0.25%, and we're lucky. Oliver Chen's in the studio with us. Oliver, good to see you, sir.
Great being here. Thanks, John.
Does Walmart win and everyone loses? Is that what's happening here?
We're excited about Walmart because it's both defensive and offensive. On the defense side, it's a leading grocer. Everyday low price is a key strategy. On the technology side, there's a lot happening to compete against Amazon, including digital marketing as well as advertising and marketplace models and platforms. So thinking about technology married with the basics of retail and features such as curbside pickup and getting a higher household income customer. And it's a low beta defensive idea in this very choppy market.
I wonder, as people trade down, if they trade down even more? And how big of a threat is, Temu, Shein, some of those kinds of names to Walmart's business?
Yeah, you're bringing up a great point. So consumer discretionary, unfortunately, has been in a recession for over a year. Temu and Shein are spending a lot on advertising. That's impacting Amazon. And the consumer discretionary trends are negative at both Walmart and Target. But it's a smaller percentage of total because Walmart is about 60% food. So we're watching that, and that's been happening. Target is more vulnerable. Target is also less expensive at 13 times relative to Walmart at 25 times. But there's a revolution taking place, ultra-fast fashion, and what these new business models are doing are something the whole retail industry is watching.
Do they have the capability to catch up to that, to go on these trends that seem to change week by week of what people tell you to wear on TikTok?
Well, Walmart's getting more fashionable, doing movies and upgrading the fashion. They have a huge opportunity to sell you more than just basics, more than just underwear and fashion. They're also upgrading private labels. So new labels like Better Goods has a cauliflower crusted pizza. We're just looking at that. And so we're seeing Walmart really intensely focus on merchandising. That's a big positive too. Also, they're getting a higher household income customer. And we see that in our survey data too, because you don't even have to go in the store. You can get on the marketplace, you can also get Apple products and Burberry Goddess, the fragrance. So we're seeing this whole transformation with merchandising getting more competitive, but Walmart really rising to the occasion.
If Walmart is taking some of these higher end consumers, where are they leaving to go to Walmart?
Well, they're taking share from many places. So I think trade down is occurring as customers think about value and appreciate value. What's happening generally in supermarkets, it's quite fragmented. So the most pressure is at local chains and non-national and others.
Are we starting to see this stress migrate to higher income earners? Because we're starting to see some bad results from luxury.
Yeah.
And I'm not convinced it's just execution from the Gucci's of this world. It seems to be pretty broad. What are you seeing from the luxury players now?
We're cautious. So our only big idea here is LVMH, which is a $90 billion revenue company. But the big caution factor is China and the property market, and that customer is so important. The other factor, correlations are quite tight to the S&P 500 performance. So the negative headwinds from the wealth effect on this pullback are going to be something to watch for sure. And we see weakness in bridal trends. So we're cautiously optimistic. However, we're out this morning with a note on retail's reset. And we like structural long-term growth opportunities on the pullback, including LVMH, ELF Beauty, and Ulta. Beauty's been a good sector.
I'm just thinking of certain consumers, certain companies that have started to pivot to premium over the last few years. It's all we've heard about coming out of the pandemic, and which companies are going to be caught offside. The demand's just not going to be there. Who's vulnerable?
Well, we're still watching Caron. You know a lot about the Gucci brand. That's a brand in transition. And we've talked about this before, stealth wealth, quiet luxury, these no logo trends, they're really working. So there's winners and losers. We're most excited about LVMH, the powerhouse brands, Dior and Louis Vuitton. They spend $10 billion in marketing. That really matters. And Arnault really protects his brands for the long term with very little discounting. Gucci's a brand in transition, so we're hopeful. And Cartier, we're not recommending Richemont, but hard luxury has been more timeless generally. And thinking about timelessness is a key factor of what new generations really care about.
Do you like LVMH because they have a service component? It's not just luxury goods. They also have hotels.
Yeah, I think the future is experiential and thinking beyond just collecting stuff. The core of the business is fashion and leather, but service and these fabulous stores that are much like churches around the world to these brands are part of the magic. And luxury does have to be emotional and offer you really that post-purchase, pre-purchase, and the whole transaction being very special to really overpay a lot for great stuff.
Are people not getting married? What's up with bridal trends?
It's been a tough compare. So bridal's been tough, and that's been tough on Tiffany.
I was just going to say.
It'll happen. I mean, people will love each other and get married.
Thanks.
But people are younger generations are generally getting married a little bit later.
Yeah,
it's something we're watching, and many ways to express love, from travel to other things.
Very true.
And the blueberry pound cake at Costco, we love Costco.
That's
too.
another way of expressing love. People will still love each other. Thank you, Oliver Chen of TD Cowen.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.